fundsupermart.com.
What is your outlook for developed markets for the remaining of 2017?
We continue to be very positive on developed markets. We think that we're in an environment where we continue to see benign inflation. Growth continues to be fairly robust, especially in Europe now, as well as in the US. And also we see that corporate earnings continue to be fairly healthy as well. So across the board, across most of the markets that we invest in developed markets, we continue to see a fairly benign growth environment. And so that has the backdrop to support equity markets in going to the remaining year of 2017.
Can you share with us your investment philosophy on the developed markets? What countries and sectors are you positive on?
Our investment philosophy is driven by investing in countries or sectors with improving fundamentals. So when we go about asset allocating across the countries, we want to look for relative value across those countries. So what is really showing up in terms of our screening now, in terms of the three developed markets that we invest in, which is US, Europe, and Japan, on a relative basis, Europe and Japan stands out now. And so in our portfolios today, we are slightly overweight on Europe and Japan versus the US. Why are we doing this? Well, because the US market basically has been driven by fairly well this year. But on the back of that, on a relative value, we started to see that Europe now is starting to show up in terms of our screening. Corporate earnings is recovering. We have started to see a stabilization in terms of European GDP. We had 2 quarters of 0.6 to 0.7% of GDP growth. Earnings is starting to show up, and valuations remain quite compelling at this juncture. And so that's the reason why we started to look at, and you started to see the performance of Europe getting better. The second key point on Europe as well is that monetary policy remains fairly healthy. We started to see, for example, the ECB, although they talk about contracting the balance sheet, I think we are not going to see a massive contraction in the balance sheet. So liquidity will continue to flow in, and I think inflation will start to increase gradually as well. On Japan, I think Japan is more of a laggard play versus the US. We think that the corporate earnings also remains fairly healthy. And also this in the backdrop of a fairly strong liquidity environment by the Bank of Japan, for example. So all in, we think that on a relative basis, the Japanese market as well as the European markets give us more value relative to the US market.
What will be the headwinds that investors should look out for with regards to their investments?
Going to the second half of 2017, what we are fairly cautious about is 2 things. One of which is in the US, the Federal Reserve has started talking about shrinking its balance sheet. Although we think that they may not shrink it dramatically, it may impact interest rate expectations going forward. As you probably know, interest rate expectations does have a bearing in terms of equity markets as well as the fixed income market. But we don't think that the tightening cycle in the US is going to be as bad as it was, for example, in the taper tantrum in 2013, for example, right? The other second point to make is that we also need to look out for the potential tightening cycle in China. China's GDP was just reported in the second quarter at 6.9%, much higher than expected. And so concerns are now that the economy may start to be in a mode where it's slightly overheating, particularly in the property market, for example. But we are also not that concerned because we think that going into October, when the Chinese party meets up for its Congress, we think that growth will continue to be fairly stable. Stability is a very, very important part of the Communist Party. And so we think that going into further in the next 2 quarters, inflation is going to be stable, growth will be stable, and therefore, even though whatever tightening that may happen globally, it may not shock financial markets.
Taper Tantrum 2.0. How aggressive do you think the Fed tightening policy will be? Should investors fear Taper Tantrum 2.0?
We think that the Federal Reserve will have probably another 25 basis points to tighten for the rest of this year, right? Is 25 basis points really a significant tightening? Not really, right? So essentially, if you think about it, Taper Tantrum 2 is already well publicized, right? It is well known in the market. Everybody talks about it. It's no real surprise. If you were to think about what happened in May 2013 when Taper Tantrum 1 happened, for example, right? essentially it shocked the market because it wasn't kind of predicted. Today, the Federal Reserve has been talking about it months and months ahead of the market. So the market is quite used to it. So to me, there's no real surprise. And also, we live in an environment where, for example, inflation continues to be low globally, particularly in the US, right? Growth is growing, but it's not growing back to its crazy levels of 3 or 3.5%. It's only growing about 2.5 to 3%, right? So essentially, what I'm trying to say here is that we live in a world where inflation is low, growth is subdued, right? And at the same time, financial markets volatility across most markets, particularly in the US, continues to be very, very low. Historically, right, if the volatility index do not spike up, there is no real case for a lot of Federal Reserves, for example, to actually loosen or tighten dramatically. So to answer your question, taper trend 2 to me is not really an issue.